It's Brian Preston, the money guy.
I want to hit the big one first, which is life insurance.
Sure. And that pyramid, that's the biggest base, right?
Yeah, well, life insurance is because what does life insurance protect? There's multiple purposes for life insurance. The biggest one that probably hits the biggest portion of the population is to replace income. Because you're worried when you're a younger person, maybe you're in your 20s, 30s, 40s, even 50s, where you still have children living in your house, you still have a spouse that's got a mortgage. You got all these things that are requiring that you have money coming in to pay the bills, to pay the obligations. So the biggest thing that life insurance can do is it can replace income. Now, when you go further up the financial planning needs list for insurance, it can get into estate planning, and I'm going to talk about that in a split second. And it can go into that level of coverage as well. But the biggest thing that it does is it replaces income to cover the living expenses, pay off those outstanding debts like your mortgages, and then fund those life goals, whether it's college for your children, whether it's just making sure that your spouse has resources for an extended period of time when you're gone. That's what life insurance, and that's what we really want to talk about today.
So is this an accurate statement for most people, for the general population? Now, obviously, there are some uniques, but in order for you to be someone who needs life insurance, you need to be someone who has other people depending on your ability to generate income.
Yes, there's one caveat though.
Okay.
And this is a big one we talk about because we see it all the time when people come and talk to us. You'll have a couple, and one will be the primary breadwinner, and the other one is taking care of the house. They're kind of the household CEO.
Sure.
It's a common misconception that you need to have tons of insurance on the income winner, and then the support, the household CEO, no need to have insurance on them because they don't generate income. However, and this is something that a key point I want everybody to understand. Like myself, my wife stays at home to help out because we have a lot of stuff going on with, I have an autistic daughter, I have a middle schooler, so there's a lot of life things that are going on. If something should happen to my wife, I would be devastated. And yes, I am the primary breadwinner, but you got to imagine if something happened to her, probably not going to be the most productive creator of income for a good period of time, maybe 6 months. Yep. Who knows how long this is going to impact me. So I think that you should buy some type of insurance, even on that support person who's not generating income for the household, because more than likely you have to go hire somebody to provide those services that are no longer being provided by the unfortunately the losing of a loved one. But also you might need to replace your own income for an extended period of time while you're going through the grieving and recovery process. So don't look past just what everybody in the household's doing. Right. Now let's start talking about that spouse though that is generating income. How do you come up with a good baseline of how much insurance you should buy? A good rule of thumb, and you hear this, and it's a very simplified way of doing it, is just take your income, multiply it by 10, and that can give you a good baseline understanding of how much insurance you need. Now, you probably, if you want to go a little deeper into just using that 10-time multiplier, you might want to add, if you have a $150,000 mortgage, a $200,000 mortgage, maybe add that on top of the 10 times. And then if you have some college planning goals, you can add that as well. But you're going to quickly see that number can elevate into 7-figure land very easily. If you have a mortgage and you're in your 40s and you're still working, you might need to buy $1 million. You might need to buy $1.5 million of insurance. So then the question comes, is that term?
Right.
Is that whole life? Is that some variable product? That's where.
And Brian, real quick, what's the difference in term and whole life insurance?
Well, here's the thing. You have permanent insurance and you have term insurance. When we use the word permanent insurance, it's because there's two components of it. Whereas there's the insurance that's replacing, that's the protection. You're buying insurance in case you pass away that shows up, but then but then that's term, but permanent has that component, but they also have a cash value, which means, and the way this is supposed to work, the way this is taught is that while you're young, insurance cost is dirt cheap. But as you get older, insurance cost goes up significantly because obviously mortality is much more likely to occur for an older person than a younger person. So if you'll build up cash value, that will help offset that premium increase that's going to occur over time. It will level out what's going on because you'll have the cost of insurance and then you'll have the cash value working in the background. The problem with that is that hopefully your need for insurance is going to go away because you're building financial independence in the background.
So our need for life insurance decreases as we build our assets.
Exactly. So when you're 30 years old and you have a good income, but you don't have a lot of assets working for you, that army of dollar bills haven't built up yet, you probably need a lot of life insurance. If we just take somebody who makes $200,000,
okay,
multiply it by, even let's just back it down to something even simpler, $100,000. Okay. Multiply that by 10. That's $1 million worth of life insurance.
Okay.
You can buy $1 million worth of life insurance when you're 30 years old for, it doesn't cost much at all.
$400 a year,
yeah,
maybe?
It's pretty cheap. And whereas if you look at somebody who's selling you permanent insurance, they could be charging you a premium of $3,000, $4,000 a year. And what they'll tell you is yes, it's more expensive now, but when you get to be, you're 60 years old, you think of, you're not going to have any increases. What I'm telling you though is at 60 years old, I'm hoping you don't even need insurance.
You're self-insured at that point.
So that's why I do like term insurance to replace income, because you're hoping that here's how you can figure out how long of a term you ought to buy. I always tell people, when will that last child be out of the house, have all their education goals funded, and when do you perceive that you'll be financially independent? For a lot of people, that's 60, 65 years old.
Sure.
So buy the life insurance that the term is guaranteed, the premium is guaranteed for that extended period of time. And for a lot of people, that's 20 years.
Perfect.
Or 25 years, something like that. But 20 years is probably easy if you've got some kids who are 2 or 3 years old. Go look at a 20-year term policy.
All right, so I'm sold. I need insurance. Where do I go? How do I pick that up at Publix? How do I go get some insurance?
Here's the thing, and I think what you're getting at, Bo, is do you buy from a person or do you buy from a website? And I would tell you, go do your research on a website. There's all kind of websites on the internet if you go do a search for life insurance rates. But I would recommend, once you figure out, what it's going to cost, I like people buying from a person, because here's what's not known. I know the internet makes things so much cheaper and more efficient. We all know, I'm buying my toilet paper now from Amazon, just like everybody else is. But the problem is that state insurance commissioners typically regulate what insurance companies can charge in your state. So there's no difference between an individual selling you the insurance versus a computer or a website, I should say. So in that case, you might want a person, because guess what happens? Something happens to you. It's nice to have somebody who's accountable to go to. Now you can find, there's hybrids where you'll have agencies that have, I'll mention one that's here local, Xander Insurance, has a big company that you can go use their tools, but then they'll have people that can help you if you needed to actually speak to somebody.
Sure.
But just know that the insurance commissioners regulate premiums, so it might benefit you to buy from an individual. The other thing I wanted to make sure I talked about, people will say, well, why would you want permanent insurance? I hear about whole life. Estate purposes, and I have recommended this to clients. I had a prospect, who worked with me for a number of years, became a client who had 8-figure wealth in real estate.
Okay.
Came to me, did not have a lot of liquidity, but had 8-figure portfolio of houses in some beautiful places of the country, not a lot of liquidity, but he had a huge estate issue. Now, the good news is estate issues have gone, they're not as big as they used to be. It used to be if you had $675,000 or $1 million estate, you needed to go buy insurance to cover the estate taxes.
And it's pretty easy to hit that. Somebody with a paid-for house and a 401k, you get pretty close to that number.
Now the number is $5,490,000, and it's portable, meaning that if a spouse doesn't use all of their $5 million exemption from estate taxes, they can take it with them and add it to their $5 million. So you can quickly see that a couple you'd have to have an $11 million estate to really need the estate planning side of life insurance. It's made things much, much easier. So I think permanent insurance is not as useful for estate purposes unless you have a unique situation like that client that I had a number of years ago, 8-figure a portfolio of illiquid real estate. If he'd passed away with that, he would be in a heck of a bad situation. So permanent insurance was a perfect solution to immediately fix that while he was trying to figure out how he could either get more liquidity in his portfolio or figure out some planning
Sure.
opportunities outside of that.
So before we go on to the next one, I just want to do a quick little rundown summary. If you're someone who has someone depending on either what you do for the household or what you bring in income, you probably need to have life insurance. When you're young, you likely need more life insurance than later in life, assuming you're building your assets. And a nice rule of thumb is you want to have about 10 times your annual income in insurance. For most people, term insurance is the best way to get the bang for the buck, to get as much insurance possible at the lowest cost possible.
Yeah, there's no investment component with term insurance. It's all just insurance. And so you're getting what you're paying for. There's no component out there.
When it comes time to buy, do your research, do your shopping online, and then try to find a warm-blooded person to help you with the process.
Yeah, just so you have some accountability if you ever need that money needs to be actually, somebody has to go figure out how to process the life insurance benefits.
Perfect. Life insurance check.